Yo, what's up everyone? It's your boy Bro, and let's be real, we all want to grow our money, right? You see that Lambo cruising down the street, and you think, one day. But here's the thing, you don't need some magic formula or to win the lottery. The real secret to building wealth is simpler than you think: smart investing. Whether you've got a few bucks to spare or a stack of cash burning a hole in your pocket, the key is to make your money work as hard for you as you work for it. So stick with me for the next few minutes, because I'm about to break down 5 powerful investment tips that can completely change your financial future. Alright, let's dive right into the first tip, and this one is absolutely crucial. Start early. I'm talking about investing as soon as you possibly can. The earlier you start, the more time you give your investments to grow and benefit from the power of compounding. Now you might be thinking, but bro, I'm still young, I've got time to figure this stuff out later. And yeah, you're right, you do have time, but the earlier you start, the more time your money has to grow. Time is a crucial factor in the growth of your investments. It's like that saying, the best time to plant a tree was 20 years ago, the second best time is today. The same principle applies to investing. Think of it like this. You're not just investing money, you're investing time. And time, when combined with consistent investing, can yield incredible results. And when it comes to investing, time is your best friend. The longer your money is invested, the more it can grow. This is because of a magical little thing called compounding. Compounding is like this snowball effect where your money earns interest, and then that interest earns interest, and then that interest earns even more interest, and it just keeps building and building on itself over time. It's a powerful force that can significantly boost your wealth. Let me give you an example. Let's say you invest $1,000 today and it earns an average annual return of 7%. After just 1 year, you'll have earned $70 in interest, bringing your total to $1,070. Not bad, right? But here's where the magic happens. In year 2, you're not just earning interest on your original $1,000, you're earning interest on the entire $1,070. This means your interest is now earning interest. So instead of earning another $70, you'll earn a little bit more. This additional interest might seem small at first, but it adds up over time. And this pattern continues year after year. The longer you let your money compound, the more significant the growth. The longer you let your money compound, the more powerful this effect becomes. It's like a snowball rolling down a hill, gathering more snow and growing larger. If you were to invest that same $1,000 and leave it untouched for 30 years, with that same 7% annual return, you know what you'd end up with? Over $7,600. That's the power of compounding over a long period. And that's just from one initial investment. Imagine the potential if you make regular contributions. Now imagine if you consistently invested over those 30 years. The numbers start to get seriously impressive. Regular investments can exponentially increase your wealth. So don't wait. Start today, even if it's just with a small amount. Every little bit counts and can grow significantly over time. Alright, let's move on to tip number 2. And this one is all about protecting your hard-earned cash diversification. Diversification is a strategy that can help you manage risk and reduce the volatility of your portfolio over time. Now you've probably heard the saying, don't put all your eggs in one basket. This age-old adage is especially relevant when it comes to investing. Well, the same goes for your investments. By spreading your investments across various assets, you can mitigate the risk of any single investment performing poorly. You see, the thing about the market is, it's unpredictable. Market conditions can change rapidly, and what seems like a sure bet today might not be so tomorrow. Some years, certain investments will skyrocket, while others might take a dip. This fluctuation is a natural part of the investment landscape. And if all your money is tied up in just one or two things, you're putting yourself at a lot of unnecessary risk. Diversification helps you avoid this pitfall. Think of it like this. Would you rather bet your entire life savings on one hand of poker, hoping for a big win, or would you rather spread your bets across multiple games and increase your chances of winning something? The latter approach is much safer and more strategic. Diversification is all about spreading your risk so that even if one investment doesn't perform well, you've got others to cushion the blow. This way, your overall portfolio remains more stable. So, how do you actually diversify your portfolio? It's not as complicated as it might seem. Well, it's all about finding the right mix of investments across different asset classes. This means balancing your investments in a way that aligns with your financial goals and risk tolerance. Now, asset classes are just fancy words for different categories of investments, like stocks, bonds, real estate, and even things like gold and crypto. Each of these has its own risk and return profile. Stocks, for example, represent ownership in a company. They can offer high returns but come with higher risk. When you buy a stock, you're essentially buying a tiny piece of that company. This can be a great way to grow your wealth if the company performs well. Stocks are generally considered riskier than bonds, but they also have the potential for higher returns. This makes them an attractive option for many investors. Real estate is another popular asset class. It offers a tangible investment that can provide steady income and potential appreciation. This could be anything from buying rental properties to investing in REITs, which are like mutual funds for real estate. Real estate can be a great way to diversify and add stability to your portfolio. Alright, let's talk about tip number 3, and this one is all about mastering your emotions. Avoid emotional investing. This is crucial because your emotional state can significantly impact your financial decisions. Now, this might be the most important tip of all because, let's face it, we humans, we're emotional creatures. Our emotions can be powerful drivers of our actions, often leading us astray. We make decisions based on how we feel, and sometimes those emotions can lead us to make some pretty bad financial choices. It's easy to get caught up in the moment and make impulsive decisions that we later regret. Think about it. You see the market crashing, everyone's panicking, and you're suddenly hit with this overwhelming urge to sell everything before you lose it all. This is a common reaction, but it's often the wrong move. Or maybe you see a particular stock skyrocketing, everyone's talking about it, and you feel like you need to jump on the bandwagon before you miss out on the next big thing. The fear of missing out can be just as dangerous as the fear of losing everything. But here's the thing, emotional investing is a recipe for disaster. When you let your emotions take the wheel, you're more likely to make hasty decisions that don't align with your long-term goals. When you let your emotions dictate your investment decisions, you're more likely to buy high and sell low, which is the exact opposite of what you want to do. This can lead to significant financial losses over time. The key is to stay calm, rational, and stick to your long-term investment plan, no matter what's happening in the market. This requires discipline and a clear understanding of your investment strategy. Remember, the market is cyclical. It goes through phases of ups and downs, and this is a natural part of its behavior. It goes up, it goes down, and it goes back up again. Understanding this can help you maintain perspective during volatile times. Trying to time the market perfectly is nearly impossible, even for the experts. Market timing requires predicting the future, which is inherently uncertain. So what can you do to avoid emotional investing? The answer lies in preparation and planning. Well, first and foremost, have a plan. A well-thought-out plan acts as a roadmap, guiding you through the ups and downs of the market. Before you even think about investing a single dollar, sit down and figure out your financial goals, your risk tolerance, and your time horizon. These factors will shape your investment strategy. Write it all down and create a clear investment strategy that aligns with your goals. This written plan will serve as a constant reminder of your objectives. Having a plan will help you stay focused and disciplined when the market inevitably gets choppy. It will keep you grounded and prevent you from making impulsive decisions based on short-term market movements. Alright, let's move on to tip number 4. And this one is all about being a savvy investor. Invest in what you understand. Now, you don't need to be a financial expert to make smart investments, but you do need to have a basic understanding of what you're putting your money into. Think of it like this. You wouldn't buy a house without first getting it inspected, right? You'd want to know what you're getting yourself into, understand the potential risks, and make sure it's a sound investment. The same goes for any investment you make. Don't just blindly follow the crowd or invest in something just because you heard it was the next big thing. Take the time to do your own research, understand the fundamentals of the investment, and make sure it aligns with your investment goals and risk tolerance. So, how do you actually go about researching an investment? Well, there are tons of resources available online and offline. You can start by reading books, articles, and financial websites. There are also plenty of educational videos and podcasts out there that break down complex financial concepts into easy-to-understand language. Don't be afraid to ask questions either. Knowledge is power, my friends. The more you know about investing, the better equipped you'll be to make informed decisions and grow your wealth. Alright, let's wrap things up with tip number 5, and this one is all about playing the long game. Think long term. Now, in a world of instant gratification and get-rich-quick schemes, it can be tempting to look for shortcuts and try to make a quick buck. But when it comes to building real, lasting wealth, patience is key. Investing is a marathon, not a sprint. It's about making consistent contributions over time, riding out the market's ups and downs, and letting the power of compounding work its magic. Don't expect to get rich overnight. In fact, if anyone promises you quick and easy returns, run the other way because it's most likely a scam. Building wealth takes time, discipline, and a long-term perspective. It's about setting realistic expectations, staying the course, and not getting sidetracked by short-term market fluctuations. Instead of trying to time the market, focus on time in the market. The longer you stay invested, the more time you give your money to grow. And as we learned earlier, time is your best friend when it comes to compounding. So, how do you actually stay committed to a long-term investment plan? Well, one way is to automate your investments. Set up automatic contributions from your checking account to your investment account each month. This way, you're consistently investing, regardless of what's happening in the market. Remember, investing is a journey, not a destination. There you have it, folks. 5 powerful investment tips that can help you boost your wealth and achieve your financial goals. Remember, the best investment you can make is in yourself and your financial education. So, which of these tips resonated with you the most? Drop a comment below and let me know which tip you're going to apply first. And don't forget to like this video and subscribe to the channel for more money-making insights and tips to help you achieve financial freedom.